Today we'll go over another Excel VBA application for creating an optimal stock portfolio using the efficient frontier theory. So in this application, we assume that you have some financial knowledge about this particular theory and model that we're going to use. I will discuss briefly the concepts and ideas and the mathematics behind it. But a lot of it will be easier if you have actually taken a basic course in finance or financial calculus in an optimization course. Okay, so we will be putting together a stock portfolio based on real-time price data from an API that we have used before. So you'll see that the use of Alpha Vantage API. So hopefully that is familiar to you. So we have a few learning objectives. We will be building an efficient frontier model. Efficient frontier is the set of optimal portfolios that offer the highest expected return for a defined level of risk or the lowest risk for a given level of expected return. We will be looking at a stock portfolio. So a little bit of definition. A portfolio is a selection of company stocks of varying quantities. So you may have 10 shares of Amazon and 5 shares of Apple. That will be a portfolio. So a portfolio is basically a list of stocks and also how much you have in each stock. So you may have more Amazon and less Apple, or maybe you have fewer Amazon stocks and more Apple, or maybe you decide to add another company, or maybe you decide to remove Amazon. So those are all sort of portfolio choices and decisions you can make. The overall return of that collection of stocks is what we call a portfolio. The portfolios that lie below the efficient frontier. So efficient frontier is a curve. So I'll show you the curve over here. We'll be constructing the efficient frontier by running 11 scenarios of different stock combinations. The list of stocks is fixed, right? So you select a list of stock, but then you can try different combination of numbers. So these are 11 different runs, and we can actually draw a curve based on the performance of these 11 runs. So by looking at the efficient frontier, you can look at the risk level. So this is higher risk, this is lower risk, looking at the different combinations of stocks. So this is a combination, this is another combination, so on and so forth. And then you can ask yourself, what's my risk tolerance? Do I want a high risk portfolio? I would go this way. If I want to be a little bit more risk averse, I'll pick the more conservative combination. So portfolios that lie below the efficient frontier are suboptimal because they do not provide enough return for the level of risk. Portfolios that cluster to the right of the efficient frontier are suboptimal because they have a higher level of risk for the defined rate of return. So basically, when you go above, it's more risky. When you go below, it's less risky, but also you also have very little return. So the return goes down. You can always see that there's a positive relationship between risk and return. So the higher the risk, the bigger the return is. But if you go extremely conservative, you're not going to be able to get a whole lot on your return. Like over here, you're getting into negative return regions, which you probably don't want to mess with. Okay. So we're going to learn how to use standard deviation and variance. Basically, standard deviation is just the square root of variance. So we're going to add variance here as a measure of risk. And we're going to use the MMULT function in Excel to calculate matrix product of two arrays. So this is a new skill that we're going to have. We're going to create and automatically update a chart. We will also be reviewing some skills that we have had previously. Data retrieval from a stock price data API Alpha Vantage is something we have used before, so we'll see the use of that again here. We'll also, again, automate the execution of the solver problem, okay, and make sure that you reference solver. Well, we have already done that in our previous assignment, so if you already done that with your computer, you should have reference to solver. You should also update this. We'll also review how to update the status bar, which is at the bottom of the Excel spreadsheet. And it'll tell us which run is currently going through, right? So out of the 11 runs that we're going to run. We'll use the multi-column list box. We've done that before. So again, we're going to have a 2-column list box. The first column is the company name. The second column is the stock. The first column is the ticker symbol, and the second column is the company name. And we're going to use these settings of the list box to make it run properly, right? So we use multi-select property equal to, column counter equal to, row source equal tickers from the ticker spreadsheet, and the tickers sort of range. But you can use these settings. We'll go over how these settings are used to specify the list box properly. Again, this assignment or demo assumes that you have some knowledge of the efficient frontier theory from finance, that you have some basic knowledge of statistics, standard deviation, variance, covariance, and matrix algebra. Okay, so a little bit of review of the efficient frontier theory. The theory is about a stock portfolio, and the portfolio is basically a list of stocks. So you can look at the stock invested in asset I. So I can be A, B, C. So A could be Apple, right? And B could be Amazon. C could be Microsoft. So you have like these different assets, and each one of them have a return value. So the return is RA, RB, and RC. So they have different levels of return. And then we're going to specify the number of shares that we're going to have. So the weights are, they specify how much you're going to have for Amazon, how much you're going to have for Apple, how much you're going to have for Microsoft. So you have these different weights, and we're going to constrain the weights to add up to 1, which is 100%. But basically, what you're trying to say is that if I increase the shares of Amazon, I have to decrease the number of Apples. That way, I have a constant number of shares so that I can compare it properly. Okay, so basically, we can calculate the portfolio return. The entire portfolio's return would be just the individual returns times the weights, and we will add them up, and that will be our total. The subscript X is the weights, right? And the expected return, which is the mean. So this is the we can look at this as a random variable, and we can calculate the mean of this random variable as the expected value. And the expected value is simply the weight times the mean return for the first stock, the mean return for the second stock, the mean return of the third stock, and then we can calculate the variance. And the variance is basically the weight of the weight square term of the weights times all the variances, and then the weights times the covariances. So the covariances are, as you can see, this is the weights XA times XB is the weight for the first stock times the weight for the second stock times the covariance between the two. So basically, we need the 3 covariance terms between the stocks, and then we can add them up and calculate the variance term for the portfolio. Okay, so in order to do that, we have to calculate the covariances. And in matrix notation, the variance for the portfolio will basically be the vector of the weights times the vector of the covariance. So sigma is the covariance matrix. So we can, so basically the key is that we already have, we can, the solver optimization program will be able to generate the weights matrix for us. And so we'll just need a way to calculate the covariance matrix, and which we can easily do using the ML function in Excel. So here's a little sort of flow. It's not a very kosher flow chart, but I want to show you like all the different worksheets so that you have an easier way of understanding and memorizing the steps. Okay. This application identified the efficient frontier for a user-selected portfolio of stocks, right? So we start with the user. So the first step is for the user to see a user form. So the form will show the user a list of stocks, form stocks. Okay, but the stock information, the list of stocks actually comes from the spreadsheet ticker. So ticker has a list of all the symbols and the company names, and that list is used to populate this user form. The application retrieves stock closing prices from the Alpha Vantage API. And so that is the query. Okay, the query worksheet stores all the closing prices for the chosen stocks, and they're stored on the spreadsheet. Each stock, you know, a new query, temporary, it's a temporary worksheet. A query worksheet is created for each stock. So if you choose 5 stocks, you'll get 5 of these. There's a loop that goes through all these. And then the returns are calculated for each of these stocks on these individual query worksheets. And once they're calculated, the returns are calculated, then they're aggregated into the returns worksheet. And so the return worksheet summarizes all the stock returns for all the stocks that you have chosen. And then we can calculate their summary statistical means, standard deviation, correlations, and those are added to the model worksheet. The portfolio selection optimization model is then constructed and solved on the model sheet. The model looks for an optimal weight for each stock. So remember, we want the weights to add up to 1, and the goal is to find the optimal sort of balance of weights. The weights will indicate fractions of each dollar invested in the chosen stocks. The objective is to minimize variance. We have to find a way to calculate variance, which we are already seeing the formula. So our goal is to minimize that variance. The solver can do this for us, right? And then we have a bunch of constraints. We need to constrain this to a minimum mean of return. So we do not want a return to be too low. So we'll specify our minimum tolerance level. Okay, and we actually go through a bunch of different tolerance levels. You see that. The results are displayed in tabular forms on Calc Efficient Frontier, and also a scatter plot on Efficient Frontier. The tickers sheet has the list of stocks from which the user can choose from. So this is the sort of the database of the tickers. Okay. So when we push this button, the model will start running and you'll be able to see what happens. Okay, so we'll do this after we take a quick look at the other worksheets. So we have seen the ticker spreadsheet. It's just a list of company names. The return is calculated, right? So the return is calculated after the model has been run. So I'll probably move the model over here. And the return is calculated after it's a summary of these 2 stocks. So you can see that previously I chose 2 stocks, and so we now have a summary of these 2 stocks return over the last 100 days. Okay, but these 2 stocks were calculated individually on their own query forms, and those query worksheets were used temporarily to calculate the returns, and then they were deleted. when the model is running, so we can see the model. So the model has an objective. This is a solver model. You can see that we have solver set up over here. And you can see that our goal is to minimize, okay, minimize over here to of the portfolio variance right here in this cell. And then we'll do that by changing the weights, right? So we have the weights cells over here, and then a bunch of constraints. So we want the weights to add up to 1. We want the weights to add up to greater than 0. So there's a greater than 0, a positive constraint. And then the most important thing is that we want the mean return to be greater than the minimum requirement level. Okay, we have 11 different requirement levels that we are going to try. Okay. So you can see that the objective is to minimize portfolio variance, and the variance is over here coded in blue. So I've color coded everything so it's easier for you to see. We'll change the weights of the stocks, right? So the weights are over here, the stock symbols here. So this table will change depending on what I ask for. The stock symbols, there are 2 because I chose 2, but then, you know, you could have 3 or 4 or 5, right? So there are a bunch of different options that you can have. The constraint, okay, so the constraints, there are 2 main constraints. The total weights, so the total weights is over here. This is the sum of all these. And the total weights has to be greater than 0, and they have to add up to 1. So this has to be equal to 1, greater than 0, and ideally equal to 1. The mean return has to be, so that here's another constraint. This constraint, we'll make it green so you can see it better. Okay, so this mean return, okay, so you can see the sum of products of the weights and the means. That's the mean return has to be greater than this required return. This required return is 11 different levels. It's the minimum return plus 10%, 0%, 10%, all the way to 100%. So we do increments of 10%. So these are 11 different levels that we're trying. You can see the details of the 11 runs on this calculation. Okay, so this is 0%, 10%, 20%, all the way to 100%. So these are the requirements, right? So 0%, which is the minimum. And then we add 10%, we add 20%, all the way to the maximum. So this is from the minimum return to the maximum return. And we can calculate the optimal weights for each level. Okay, so this is just a reminder of how variance is calculated. This variance, okay, so this equation, variance is the sigma squared, this notation, is basically the weight matrix over here, okay, and then we have the covariance matrix, and the transpose of the weights matrix, the 2 of them, we can do a matrix product over here, matrix multiplication. And then once these 2 are multiplied, then we multiply the with the weights matrix. Okay, so this is basically how this variance, okay, this variance, portfolio variance equation, how this is put together. And I think that's it. So you can actually see the covariances are actually calculated over here. So this is the covariance. This is the covariance, 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 right? So these are the covariance of these 2 stocks. And the covariances are used, the covariance matrix is right here. This is the covariance matrix. And this entire covariance matrix is used to calculate the portfolio variance, right? So you can see the covariance matrix over here. All right, so it's a fairly complex model, but once you understand the mathematics behind it and you have set up the model properly, then it'll always run correctly for you. So let's try this by pushing the button here, and we'll see what happens. So when you click the button, the first thing you see is a list of companies. So these are ticker symbols from the tickers worksheet, and you can select companies that you would like to obtain data for. So you can have a portfolio of companies that you're interested in. Say I'm interested in Alcoa, Amazon, Apple, Applied Materials, Bank of America. Well, that may be a little too much, so let me deselect some of these so I don't have too many. Let me just have 3. Let me just have 2. Okay, so Alcoa and Amazon, let's just try this and then hit OK. So this will trigger the next thing is to trigger the query, right? So this is after the form. The next thing is to trigger the query of these 2 stocks data from 100 days ago, over the last 100 days. So we'll get 100 days, spreadsheet for Alcoa, spreadsheet for Amazon, and those will be used to calculate the returns. So we'll put together a return summary spreadsheet that we can use to calculate the model. So the model is running now. You can see that it's creating, it's downloading. So we are retrying the web query. So we're running query for Amazon, but it did not succeed. The web query failed. So we can abort this. See what's going on. So you can see that a temporary worksheet was created for AA, American Airlines, and a temporary worksheet was created for Amazon, but we were unable to get the data. The first round, we were able to get the American Airlines data. Well, it aborted. We retried and it worked out fine, but we actually had trouble with Amazon. We could have retried that. So let's just try it again. So let me do Alcoa and Amazon. Okay, so you can see it's running query for Amazon. So we can retry. It's retrying now. And now it's running web query for Amazon. Now, it didn't work, so let's retry. Oh, everything worked. So we had some, that was a little scary, but everything worked out. We just need multiple web tries. Okay, so you can see that we have successfully downloaded the American Airlines data set, and we successfully downloaded the Amazon data set. And this is actually the calculate column for return. This is the calculate column for return. These are the data that we downloaded. These are the timestamps. You have to expand a little bit to see the timestamps. And then you will see the high and the low, the open, high, low, close. I'm not sure, this may be volume. Okay, and then the return is basically, you can see this return is basically just this minus this, right? So today versus yesterday, and then divided by today's data will become the percentage of increase over the last 24 hours. So this is how the returns are calculated. These formulas are generated automatically by the code. And you can see the 11 runs and all these numbers were updated. You can see the return. This is a summary. This is just, we copied this return column from AA to this return column. And then we also copy this return column from Amazon, and that's put onto the returns column over here. So now we have these two returns columns. We can use them to calculate the standard deviation, the variance, and run the model. So this is the model after 11 runs. This is the 11th run, but we actually kept track of all from first run to the second run to the third run. So all 11 runs data is captured over here, and that these data are used to plot the efficient frontier. Okay, so this is it. So we have two buttons over here. You can run the model again, or you can go see the portfolio weights. Those are basically on the calculate efficient frontier tab. So hopefully this is a very thorough overview of the program. I hope you enjoy playing with the program, poke around a little bit, try different things, different settings, try different stocks. And then on Wednesday, we'll walk through the code. Thank you very much.